Launch, the blueprint for building a profit-focused partnership program in 90 days. Written by Mark Brigman, PhD, founder and CEO of Partnernomics. Narrated by Matthew Longmire. Chapter 11. Tracking and Optimizing Performance. Without data, you are just another person with an opinion. W. E. Deming. The conference room fell silent as David Park, VP of Strategic Partnerships, opened his laptop. He was seconds away from delivering the most critical presentation in his 15-year career. 9 months earlier, he'd promised the board that a referral partnership program would become a game-changing revenue channel for their human resources software company. Now, he was about to present his quarterly operations review to his board of directors and request $1 million in additional funding to establish a formal partnership management team. David faced 12 expectant faces, waiting to see whether he'd delivered on his bold vision or squandered valuable resources on another failed revenue growth experiment. David didn't rely on hopeful narratives or vague promises. He projected 3 comprehensive performance scoreboards that told an irrefutable story. The recruiting metrics were 15% ahead of projections, engagement data revealed 10 highly active partners, and revenue dashboards displayed a steady increase in new pipeline, delivering revenue that outpaced sales projections and was achieved at half the customer acquisition cost, CAC, of the direct sales initiatives. One investor leaned forward, visibly impressed, and asked rhetorically, "Why didn't we make this investment years ago?" The numbers spoke for themselves. Each partnership program will succeed or fail based on its ability to measure what matters and use the data to optimize performance continually. By systematically tracking the critical stages of the partnership lifecycle from initial recruitment through active engagement to revenue generation, David illustrated a predictable and scalable revenue engine. The board voted unanimously to approve his program expansion. Without precise performance data, partnerships become expensive experiments that executives view with skepticism rather than strategic assets that command ongoing investment and organizational support. Managing by data, not gut feel. Partnership programs have been managed by gut feelings and hopeful assumptions for far too long. Business executives commit significant resources and their teams spend countless hours collaborating with new partners, then cross their fingers and hope these investments will generate meaningful returns. They make partnership decisions based on personal impressions, partner promises, and anecdotal success stories rather than systematic data collection and analysis that reveals what actually drives results. This approach fails because partnerships involve too many variables and moving parts to be managed effectively through intuition alone. Multiple organizations with different priorities, processes, and performance standards must coordinate their efforts to achieve shared objectives. Success depends on dozens of activities happening consistently across various teams and time periods. No executive can track all these variables mentally while making the optimization decisions that separate successful programs from expensive failures. W. E. Deming captured this reality perfectly when he said, "Without data, you are just another person with an opinion. Your opinions about partnership performance mean nothing if you cannot support them with concrete evidence that demonstrates which activities generate results and which consume resources without delivering proportional returns." The most successful partnership programs utilize systematic data collection and analysis to create scoreboards that clearly communicate performance and influence the behaviors that drive collaborative success. These data-driven approaches eliminate the guesswork and subjective judgments that cause partnerships to drift without clear direction or accountability for specific outcomes. Your partnership program needs 3 core areas of performance data that work together to provide complete visibility into program health and optimization opportunities. These represent the fundamental life cycle of partnership success, from initial relationship development through ongoing collaboration and ultimate revenue generation that justifies program investment. The three areas create a cascade of leading indicators that predict future performance, providing actionable insights on where to focus improvement efforts for maximum impact. Each area builds upon the next, creating a systematic framework for understanding what drives partnership success and what prevents programs from reaching their full potential. Recruiting is the first critical area because it measures your ability to identify, evaluate, and contract with partners who have genuine potential to generate business results. Without high quality partner recruitment, no amount of management effort or program optimization can create successful collaborative relationships. Misaligned or uncommitted partners will consistently deliver poor results, regardless of how well other aspects of your program operate. Engagement represents the second critical area because it measures your ability to activate partners and motivate sustained performance that generates qualified referrals and revenue opportunities. Even high quality partners will underperform if they lack proper training, support, and incentives to prioritize your partnership among their many competing business priorities and opportunities. Revenue represents the ultimate area because it measures whether your partnership program delivers the business outcomes that justify continued investment and organizational support. Regardless of partnership type, all partnership activities must ultimately contribute to customer acquisition, revenue generation, or profit improvement that creates measurable value for your business. This three-area framework prevents the over-engineering that destroys many partnership programs before they generate meaningful results. Data collection and analysis can become highly complex and expensive very quickly when companies try to measure every possible partnership activity and outcome. This focused approach ensures that you collect the essential information needed for program management without being overwhelmed by data that does not contribute to better decision making. Companies that implement systematic performance tracking across these three areas report partnership programs that generate qualified leads within 90 days rather than hoping for results after 12 months of relationship development. Their data reveals which partners deliver exceptional results, which partners need additional support, and which partners should be eliminated from programs to free resources for more productive relationships. Lifecycle performance tracking, recruiting. Recruiting performance is a leading indicator of all other aspects of your partnership program's success. Companies that excel at partner recruitment build programs that consistently generate business results because they focus their limited time and resources on relationships with genuine potential for collaborative success. Companies that struggle with recruitment waste months pursuing partnerships that consume resources without delivering proportional returns. Your recruiting metrics must measure both the quantity and quality of partnership opportunities in your development pipeline. Quantity metrics reveal whether you have sufficient partnership candidates to achieve your program goals. Quality metrics reveal whether those candidates possess the characteristics and capabilities that predict long-term collaborative success with your organization. One of the most insightful recruiting metrics you should track is the number of companies applying to your partnership program each month. This measure indicates whether your program positioning and outreach activities generate sufficient interest from potential partners to support your growth objectives. Programs that consistently attract qualified applicants demonstrate market demand for your partnership value proposition. Application volume also reveals the effectiveness of your partner identification, outreach strategies, and incentive plans. Suppose applications remain consistently low despite significant effort. In that case, you may need to adjust your target partner profile, refine your value proposition, or expand your partner identification efforts to reach more qualified candidates. Track the number of new partner candidate engagements and contract executions each month to measure your ability to convert interested candidates into committed collaborative relationships. This metric reveals whether your evaluation and negotiation processes efficiently move qualified candidates through your development pipeline or create bottlenecks that cause good opportunities to stall or be abandoned by your program. The conversion rate from applicants to signed partners provides insights about the alignment between your partnership requirements and market expectations. Low conversion rates may indicate that your program terms are not competitive, your evaluation process is too complex, or your target partner profile includes unrealistic requirements that eliminate otherwise qualified candidates. Measure the average number of days from initial candidate identification to signed partnership contract to understand the efficiency of your entire recruiting process. Lengthy development cycles increase the probability that good candidates will lose interest or commit to competing partnership opportunities while your evaluation process drags on without resolution. This timeline metric also reveals bottlenecks in your recruiting process that may be hindering your achievement of partnership development goals. Extended delays in specific stages of your process indicate where you need to invest additional resources or streamline procedures to maintain candidate interest and momentum. Track the total number of live partners in your program based on signed contracts to monitor your program's growth over time. This baseline metric provides context for all other performance measures, helping you understand whether your recruiting activities are building the partnership network needed to achieve your revenue and growth objectives. More importantly, track the number of active partners based on recent performance rather than just contractual status. Active partners are those who have demonstrated engagement through specific actions within defined time periods, such as submitting qualified referrals within the past 60 days or completing required training programs within agreed upon timeframes. The distinction between live and active partners reveals the proper health of your partnership network. Programs with large numbers of contracted partners but small numbers of active partners indicate recruiting or engagement problems that prevent relationships from generating business results despite successful contract negotiations. Monitor your partner's satisfaction with your recruiting and onboarding process through Net Promoter Score surveys that ask partners to rate their experience and likelihood of recommending your program to other potential partners. Partner satisfaction during recruitment predicts their likelihood of investing sustained effort in collaborative activities after contracts are signed. Low satisfaction scores during recruiting indicate problems with your evaluation process, communication approaches, or onboarding procedures that may prevent partners from becoming productive contributors to your program. High satisfaction scores suggest that your recruiting process creates positive momentum that carries forward into ongoing partnership management and performance. These recruiting metrics work together to provide comprehensive visibility into the first stage of your partnership lifecycle. Companies that track and optimize recruiting performance develop programs that attract high-quality partners, generating consistent business results, rather than relying on random partnership activities to produce profitable outcomes. Lifecycle performance tracking, engagement, and revenue. Engagement metrics serve as the bridge between successful partner recruitment and actual revenue generation, as they measure whether your partners are actively promoting your solutions and generating qualified opportunities for your business. Without exception, your most engaged partners become your most productive revenue generators because engagement activities directly predict referral quality and volume. Partner engagement serves as the leading indicator that predicts future revenue performance with remarkable accuracy. Partners who actively participate in your program activities, attend training sessions, and invest time in collaborative marketing efforts consistently generate more qualified referrals than those who maintain minimal involvement despite having signed partnership agreements. Track the number of co-marketing efforts your partners participate in each quarter, including webinars, conferences, blog posts, case studies, and joint promotional campaigns. Marketing collaboration demonstrates a partner's commitment to your shared success while creating market visibility that generates qualified referral opportunities for both organizations. Partners who invest time and resources in co-marketing activities signal their genuine commitment to collaborative success rather than treating your partnership as a passive revenue opportunity that requires minimal effort on their part. This engagement creates the market presence that positions both organizations for referral success. Monitor partner participation in your training and certification programs to measure their investment in developing the knowledge and skills necessary to represent your solutions effectively. Partners who complete training programs understand your value proposition better and can identify qualified referral opportunities more accurately than partners who rely on superficial product knowledge. Where applicable, certification completion rates also indicate partner commitment levels and help you identify which partners are serious about generating results versus those who signed agreements without intending to invest the effort required for collaborative success. Use this information to focus your management attention on partners who demonstrate genuine engagement. Track partner attendance and participation in your partner business reviews to measure their commitment to ongoing relationship management and performance optimization. Partners who consistently attend scheduled meetings and actively participate in performance discussions demonstrate the professional approach that predicts long-term collaborative success. Regular PBR participation also ensures that partners stay informed about program updates, performance expectations, and optimization opportunities that can improve their results. Partners who consistently skip meetings often fall behind on program requirements and generate fewer qualified referrals than those who remain actively involved. Measure the number of partner-sourced leads generated each month to track the direct output of partner engagement activities. This metric provides immediate feedback on whether your program is developing the referral volume needed to achieve your revenue objectives, justifying continued investment in partnership development and management. Lead volume trends indicate whether your engagement activities are enhancing partner performance over time, or whether additional training, support, or incentives are necessary to achieve better results. Declining lead volumes indicate engagement problems that require immediate attention to prevent partnership relationships from becoming unproductive. Track the qualification rate of partner-sourced leads to measure whether your partners understand your ideal customer profile and can identify genuine opportunities rather than submitting random prospects who are unlikely to purchase your solutions. High qualification rates indicate effective partner training and engagement, while low rates suggest additional education or support is needed. Lead qualification metrics also reveal which partners consistently deliver high-quality referrals versus those who submit large volumes of unqualified prospects that consume your sales resources without generating revenue. Use this information to optimize your partner mix and focus resources on relationships that deliver genuine business value. Monitor partner churn rates to understand how many partners become inactive or leave your program entirely over specific time periods. High churn rates indicate engagement problems, competitive pressures, or program structure issues that prevent partners from achieving the results they expected when joining your program. Revenue metrics represent the ultimate measure of partnership program success because they determine whether your collaborative relationships deliver the business outcomes that justify continued investment in partnership development and management. Every partnership activity must ultimately contribute to customer acquisition and revenue generation, creating measurable value for your organization. Track the conversion rate of partner-sourced leads to closed deals, including the average sales cycle, to understand how partner referrals compare to your company's direct sales efforts. Many recent studies have shown that partner-sourced opportunities deliver larger deals, faster closes, lower acquisition costs, and higher customer satisfaction rates. This metric reveals the actual business impact of your partnership program as compared to the traditional direct sales-only approach. Conversion rates also indicate whether partner-sourced leads are genuinely qualified and ready to purchase or require additional nurturing that extends your sales cycle and increases customer acquisition costs. High conversion rates demonstrate effective partner training and lead qualification processes. Monitor the average deal size for partner-sourced opportunities compared to your company's direct efforts. For most organizations, partner referrals result in larger deals because they leverage the trust already established between the prospect and your partners, which encourages immediate cross-sell and upsell opportunities. Deal size comparisons also reveal which partners consistently refer high-value opportunities versus those who generate smaller transactions. This information can inform your use of role-based partnering pairings and help prioritize which partners to engage in co-marketing activities. Track total revenue from partner-sourced leads each month to monitor the direct financial impact of your partnership program on business results. This metric provides the ultimate justification for partnership investment and demonstrates program value to executives who allocate resources for your organization. Revenue tracking also reveals seasonal patterns, growth trends, and variations in partner performance, which inform optimization decisions regarding program structure, partner support, and resource allocation. Consistent revenue growth demonstrates the program's effectiveness and justifies continued investment in partnership expansion. Monitor customer retention rates for partner-sourced customers compared to direct sales customers to determine whether partnership referrals yield more loyal, long-term relationships that deliver higher lifetime value. According to multiple industry studies, partner referrals should provide significantly higher customer retention because they are based on established trust and realistic expectations. These engagement and revenue metrics work together to provide complete visibility into partnership program performance and optimization opportunities. Companies that track and optimize these measures develop programs that generate predictable business results rather than relying on partnership activities to produce profitable outcomes through good intentions alone. Recap and actionable steps. Your partnership program must be managed through systematic data collection and analysis rather than relying on gut feelings and hopeful assumptions about collaborative success. The three core lifecycle areas, recruiting, engagement, and revenue, provide the essential framework for understanding what drives partnership performance and where to optimize for the greatest impact on business results. Recruiting metrics measure your ability to identify and contract with partners who have genuine potential to generate qualified referrals and revenue opportunities. Without high-quality partner recruitment, no amount of program management can create successful collaborative relationships that justify continued investment in organizational support. Engagement metrics serve as leading indicators that predict future revenue performance by measuring whether partners are actively participating in program activities and investing effort in collaborative success. Your most engaged partners consistently become your most productive revenue generators, as engagement activities directly correlate with the quality and volume of referrals. Revenue metrics provide the ultimate measure of partnership program success by tracking whether collaborative relationships deliver measurable business outcomes that justify the time, resources, and management attention required to build and maintain productive partnerships with external organizations. Begin this step by creating a simple partnership performance dashboard that tracks the most critical metrics from each lifecycle area rather than trying to measure every possible partnership activity and outcome. Identify a few metrics from each partnership lifecycle area to avoid overwhelming your team with data collection requirements while building experience with systematic performance management. For recruiting performance, track the number of new partners contracted each month and the total number of active partners based on recent engagement activities, such as submitting qualified referrals within the past 60 days. These metrics indicate whether your recruiting efforts are establishing the partnership network necessary to achieve your program objectives. For engagement performance, track the number of partner-sourced leads generated each month and partner participation rates in your training programs or partner business reviews. These metrics indicate whether your partners are investing effort in collaborative activities that create business opportunities for your organization. For revenue performance, track the total revenue from partner-sourced leads each month and the conversion rate of partner referrals to closed deals. Compare these closing rates to those of your traditional direct sales approach. These metrics demonstrate the direct business impact of your partnership program on customer acquisition and revenue generation. Start collecting performance data immediately using simple spreadsheets or basic dashboard tools rather than waiting for sophisticated partner relationship management (PRM) systems, which will delay your ability to measure partnership program effectiveness. Even basic data collection offers more insight than relying on assumptions and gut feelings to manage partnerships. Review your partnership performance data monthly during internal team meetings to identify trends, optimization opportunities, and potential problems before they impact program results. Use this information to make data-driven decisions about partner support, resource allocation, and program structure adjustments to improve collaborative outcomes. Your systematic approach to partnership performance tracking lays the foundation for building programs that deliver predictable business results rather than relying on good intentions to achieve the profitable outcomes your executives expect. Thanks for listening. This has been Launch, the blueprint for building a profit-focused partnership program in 90 days. Written by Mark Brigman, PhD, founder and CEO of Partnernomics. Narrated by Matthew Longmire. Copyright 2025 by Mark Brigman, PhD.